Today is September 16th, 2020, Wednesday. Total unemployment insurance claims actually hit a 5-week high. Almost 30 million people. I think the correct number is 29.6 million people. The mega cap stocks also reaching multi-year put call ratios. So obviously people were extremely um, uh, bullish on call options. Hence, that is why retail traders have spent about $250 billion buying either most of them of which buying OTM call options. And even homeowners are taking out as much as $130 billion in aggregate total of equity through refinancing, through cash out refinancing. So obviously put to call ratios throughout all major indexes are extremely low, given the fact that everybody is in a speculative long position and essentially bag holding until they see what they want to see. Right? Everybody's buying because other people are buying because other people are buying. There's really no reason behind it. There's no fundamental true value behind it. And with that being said, it's kind of interesting to think about because if you think of the actual physical aggregate value proposition that the U.S. has in this environment, 60% of U.S. business closures since March are permanent. 60%, 60% of these businesses since March that have been closing down are permanent. Okay, that is so out of every 10 businesses, 6 of them are permanently gone. They're done. There's no hope for them. Okay, and that's the true reality given the extremely diverging wealth gap that we see in this country. Thank you to both fiscal and monetary policy from the federal government, as well as commercial banks, right? Because the commercial banks are actually the ones that sell these loans to the U.S. Treasury, and the U.S. Treasury sells them back to the open market for the FOMC to create a market in, and then sell back to the commercial banks. So it's a very nice cycle, but it's a manipulated one, and it's a cycle that's being misused. It's a cycle that shouldn't even be used in terms of the federal government. It should be used for the free market economy. And also an interesting thing is if you go all the way back to when exchange rates internationally were being screwed with, and then predecessors of Nixon were starting to mess around with the value of gold and the exchange value of gold and the use value of it by encouraging dollars to be printed and by encouraging fiat money to be replaced by the gold standard. That's what happened in 71. And as a result, since 1960, right, since that mess has been starting, the M3 money supply actually has been doubling on average every 10 years. Okay, so it started with, say, 500 billion, then 10 years later, 1 trillion, 10 years later, 2 trillion and 4 trillion, etc. So, and right now, we're well in the, we're extremely high. We have trillions and trillions of dollars of deficits, both trade and budget. And really there's no digging out of it other than creating more debt to roll over, the initial debt. But that's how our monetary system, when controlled by the federal government, is created. This is what happens. This is the disasters that are all trickling down systematically, and they all are, and they all will. And and also the percentage of these zombie companies that I've been bringing up here and there, zombie companies that are in the market, but there's quite frankly no attraction about it whatsoever. They have fierce manipulation arbitrarily from time to time, and the vast percentage of these are only growing, right? They're actually approaching dot-com peak levels, which is a very scary metric to look at. And also I wanted to quickly switch over to share my thinkorswim screen with you, because I made a trade today on on Kodk, and Kodk I only bought 15 shares total, 10 first at 932, and then another 5 at 910, and that averaged me to 924 average at 15 shares. Let's get on the 5-minute here as well. As you can see, Kodk has become a complete dead cat bounce oriented stock. It's the equivalent to a low float, volatile garbage small cap stock. But anyways, so I got in the pre-market because I sensed that, okay, well, we're trading over all short-term EMAs. We're colliding with, at first it was, definitely, a toppy kind of head and shoulders pattern, but it was supported by an uptrending or a higher low pattern of the EMAs. So I stuck with it and I got in as near to the EMAs as possible so I could mitigate my losses potentially if I ever had a cut. But I never cut. I actually added once it got lower because I saw that level 2 was very much supported at the time by huge blocks of buyers that just were buying that level of support over at 9. And obviously I sold just before the gates opened at 9:45. It ticked all the way to like 65 there. But not only that, out of the gates actually hit 11.5. So I completely missed out on this spike higher. And the thing is, we saw it spike, essentially that high at the pre-market highs completely failed, and it's been fading ever since for the rest of intraday. And this is the kind of stock that could easily pick back up either midday or right now or end of day, and easily pick back and go to 20. That's the kind of stock this is. It's fiercely manipulated, and it's not something you want to especially hold short. Any leverage you have on this is definitely a death sentence, and I wish you the best of luck. But anyways, yeah, I got an extremely small profit off of it. Green is better than no green, and I'm moving on with the day. Not exactly the kind of move I wanted at all. I was looking obviously for more of a immediate spike, but I was willing to hold on as it was tightening with these short-term moving averages in a higher low fashion. So that is also the increase of volume approaching the gates. So with that, I appreciate you watching the video, and I please hope that you like this video and hit the subscribe button. And just be advised that we are not financial advisors. We are not investment advisors. Anything that we say is primarily and only for educational purposes only. So thanks again. Please subscribe, and we'll see you soon.